Hello, everybody. Welcome to this UNW webinar. The subject is Associates Taking Back Control. Now, as ever with these things, it takes a little while for people to come through and be able to see what's going on. So if we'll just wait another minute or so, if that's all right. And for those of you who are Newcastle United fans like me and some of my webinar colleagues tonight, then I do apologise because I didn't check what was happening with the football, and I won't spoil it by telling you what the score at half time was, assuming there was a score, of course, which there mightn't have been. Okay, so it's a couple of minutes past now, so let's get going. Some basic housekeeping. First of all, once we get going, you might find that hopefully you'll be able to see now in the background the actual first slide in the presentation. It's the one with UNW at the top and my handsome picture at the bottom. You'll notice there that I had a lot less hair because one of the things of during lockdown of whatever it is, 15 weeks of not having my hair cut, you look like a wild man. In order to get rid of the annoying video pictures on your screen, there is a way of doing that. If you click the minimize, hover your cursor over the video screens, you'll see at the top a series of little boxes. You can click the left-hand one, that minimizes it, and you'll lose my ugly mug and get full view of the presentation. So for those of you who aren't familiar with Zoom, that's a good way to do that. Also, during the presentation, we're going to have the ability to ask questions, and I've got two of my UNW colleagues, Liam Richardson and Mike Blancan, who some of you might know. They are my senior assistants, and they will be able to answer questions. If you use the chat box, you can type questions in there, and you'll be able to get answers in real time. I've also got with me, I'll do a proper introduction in a moment, but a special guest, an extremely special guest, my favorite client. So for those of you who are clients watching this, I'm really sorry you're not my favorite client, as Bruce Forsyth would say. You're my second favorite client, of course, but my favorite client is my son, Nigel. More about him in a moment, but he is a dentist who's bought 2 practices. And if you have any questions that you would like somebody with a bit of experience on buying practices to answer whilst we're going through the presentation, then pop your question in the chat box and he will answer. We've also got a courtesy of Zoom. There is another box to ask questions, and that's called a Q&A box. If you want to ask a question that for us to answer a bespoke answer at the end of the presentation, when we've got the ability to have some questions and answers, this is the equivalent of when the presenter finishes and asks us any questions, you put your hand up and you can talk. Because we're expecting too many people that it would be chaotic to do that. The equivalent of that is we'll get to the end and we'll go through any questions that are in the Q&A box. So there's 2 methods of answering questions, asking questions, 2 methods of them being answered. Finally, when you log off, if you could do us a favor, please. This is the second webinar that UNW has hosted for dentists. When you log off, there will be you'll be asked to complete a very simple and quick survey. If you wouldn't mind doing that, it'd be very helpful to us to give us feedback. You know, if you want to tell us never to do one again because you're so annoyed with the presentation, then we can take that on board. But any other helpful suggestions would be appreciated. So okay, let's get cracking then. So the title is Associates Taking Back Control, the Inside Track to Practice Acquisition. Now the idea for this came about because there was a virtual meeting of ASPD about 2 weeks ago, and ASPD is a bit like NASDAL. Most people have heard of NASDAL, not so many people of ASPD, but this is a professional association where there are accountants, lawyers, bankers, sales agents, IFAs, all, I hope I haven't missed any out, all dental professionals. And in this workshop, in this meeting, what was said, the sales agents, their contribution was to say that they'd never seen so many associates registering with an interest in buying practices. And that's because of uncertainty and the lack of control. And to be blunt, subject perhaps of another webinar, the disgraceful way that some associates have been treated by principals during this lockdown. And I'm particularly talking here about NHS associates and the CDO's instructions. So associates taking back control. So I just thought, okay, let's do a webinar, a helpful webinar, because the interest is there. It's a good time to talk to people to satisfy that interest. So we've got the UNW team. I mentioned Liam, of the three little circular photos there, Liam Richardson in the middle, and Mike Blenkarn. Mike is on the right-hand side. Mike joined us fairly recently, 1st of May, from a competitor. Little did we know that when we offered him a position and he accepted, that he'd be joining us virtually rather than coming and meeting his new teammates. But our dental business unit has been expanding. We now up for more than 500 dentists, of which probably about half are associates. And so, you know, as part of our expansion, we needed another good member of the team to join us. We're members of NASDAL and also members of ASPD. Now, I mentioned Nigel, so now's your chance, Nigel. Explain to everybody what you're about.
So hi, I'm Nigel. I own a couple of dental practices. One I bought in 2010, which was 4 years after I qualified, and then bought a second practice much closer to where I live a couple of years ago. I also do a little bit of implantology in both my practices and around other clinics in the Northeast. And I do some lecturing for the Northern Deanery, and I'm a mentor for both the restorative and surgical phase of implant treatment.
That's great, thanks Nigel. So Nigel's going to help me by giving a dentist perspective, which I think is useful, and we'll just sort of see how it goes. What we're going to cover this evening is the steps to practice acquisition, and I've created what I hope is a useful flow chart for you, which we'll talk through in a moment. Practice values and profitability, very important. The different ways of operating a dental practice, high level view of that. Very importantly, do the numbers add up, the viability forecast. A commentary on dental lenders, and we may have some dental lenders that are watching this evening. If we have, then it's great to have you on board. And in fact, you could perhaps use the chat boxes for anything, any information that you wanted us to sort of pass on. Although recently we've had conversations with 3 of the main dental lenders, so we're up to speed. And then a commentary on offer formalities. In other words, at the time of making the offer, there's a degree of formality at that point in time. And then some very simple points to watch out for when the legal processes start. And then finally, the Q&A. So here's the flow chart for practice acquisition. Now, this isn't in a tablet of stone. I just thought it would be helpful. I'm quite often asked, the most common question that I'm asked when I'm talking to somebody that isn't familiar with buying a practice, usually a young associate buy a practice, and they say, I found this wonderful practice, Alan, should I get a valuation? Now, if you have a quick scan through there, getting a valuation doesn't appear on there at all. So I'll explain more of that later. But I'll talk you through this, and I hope you find this sort of the way that my mind works being an accountant, rather than sort of pages of screed to read through thinking, oh, goodness me, what does that mean? This is just sort of a very simple series of steps. And as I was looking at it this afternoon, sort of finalizing my thoughts on it, I thought it's a bit like snakes and ladders, because we've actually got it, it's upside down snakes and ladders here, with the ladders going down and some of the snakes going up, but you know, you'll see what I mean about that in a moment. So if we start with the green box, top left-hand corner, so you're starting to look, you're thinking, I'm interested in this. Now, I remember when Nigel was just before the green box, I was putting pressure on him. Nigel, you know, you've out of dental school, get on the ladder quickly, otherwise you're going to miss the boat. This is what I thought. This is back in 2000, and well, graduated in 2006. So, you know, just after the new contract, values were rising, etc., etc. And I remember Nigel saying to me, I'm not ready, Dad, I'm not ready. And then all of a sudden it was, I think I'm ready now. So start looking. So what do you do then? Well, the first box, putting the word out. If you can get a deal off market, then that can be really good from the buyer's point of view. Now, again, I know I should have mentioned this before. We've got quite a few viewers of this webinar who are practice owners, who are thinking, I'd quite like to sort of understand a bit more about the marketplace. So although it's perhaps not directly relevant for me, it's indirectly relevant for me. So, and there is a bit of, in all of this, it's buyers and sellers. It's a bit of a sort of a poker game, winners and losers sometimes. So please forgive me if I say something that you're not particularly happy with. I'm trying to be factual here, but certainly from the associate's point of view, from the buyer's point of view, if you can get a deal off market, great. So put the word out, find out about it from friends. Equipment reps can be a good source here. And then, of course, registering with our good friends, the practice sales agents. And again, we may have one or two of them watching this. They are an essential part of the process, a very valuable part of the process. But clearly, if you are lucky enough to find a deal off market as a buyer, then you would not have to go through the practice sales agent process. You can sometimes find out from if you've got a contact who's a banker, dental banker, they can sometimes become aware from their customers of practices for sale. Your accountant, of course, particularly if he's a dental accountant, it can be a very good source. And IFAs, there are some IFAs, dental IFAs, who are very useful. So the starting point is putting the word out. You then find a potential practice something that you are interested in, and at that point, if it's through a sales agent or a vendor, you would, if you haven't already found it through them, if you become aware of it and there is an agent in place, you make contact with them. At that point, you get the information, price, get information, the financial information. The sales agents would usually produce for you an information pack, but it's important to get accounts because you can't really, in my view, get off first base without those. And at that point, that's when you speak to your dental accountant. And so why do you do that? Because the very next stage, if you follow the blue line down, what is probably the most important part of the acquisition process is to have prepared for you a practice acquisition viability forecast. This is really an essential sort of calculation mechanism that demonstrates to you whether it's going to work or not. So you can see the blue line, the darker blue line that comes out of the top of that box where it says not okay. About a third of the practice acquisition viability forecast that we prepare for clients, no matter how much that we try and perform what ifs, we do, I'll show you more about this in a moment, but no matter what is done to try and make the deal work, regrettably, in about a third of cases, it doesn't work. So here's the snake. For those of you who remember snakes and ladders, the snake goes and you slip, in the snake's case, downwards, in this case, upwards, follow the line, it goes right back to the green dot again. You have to start again, unfortunately. However, let's assume that hasn't happened. The numbers work for you. That's great. You are comfortable with those numbers. It's an essential part of the process. The next step is to get advice from your accountant about the most appropriate structure to operate the practice. I'm going to talk more about that later on as well. But this is usually all about tax. What's the most tax efficient structure? So get advice about that. That will enable you to establish a guideline price. Now, usually what happens is, particularly if you're going through a sales agent, it will say, the asking price is whatever it might be, £500,000. But this process that we've done, this mathematical process and the tax planning process enables you to know how much that you can afford to pay for it. It might be that the asking price is £500,000 and you can only afford to do it if you can do the deal for £450,000. Now you'll notice at this point, when I mentioned before about people often saying to me, shall we get a valuation? In other words, if they were drawing one of these, the square that they would have after the green dot in the left-hand corner would be get a valuation. My advice, no, let's not do that. Because what's the point in having a valuation at this point in time? We need to know how much the deal is you can afford to pay for that practice to make it work for you. And if it's only £450,000, then unless you can get it for that price, it isn't going to work. If you're lucky, the deal will work at an amount higher than the asking price, and that often happens. In other words, you could afford to pay 600,000 for it and it would still work for you. That's great, gives you headroom. Now, I'm not being silly here that you would go and offer 600,000 for it. You'd be comfortable, you'd still do negotiating, but you could be comfortable to pay the asking price if that's what it ends up at. The next box along to the left there is to contact lenders, because you need to know whether you're actually going to be able to do the deal at all. So contact the lenders at that point in time. Sometimes, very rarely, because if the deal is working for you, often it will work for a lender, but it can be the situation that when you contact lenders that it just won't work for whatever reason, in which case it's another snake. You're back to the beginning again. The deal won't work for you. But if that's okay, if you've got sort of you won't get a certain offer at that stage, but an indication that things are looking okay, at that point you can finalize the negotiations with making your offer. And as you can see from here's another snake leading up from that box. Sometimes you can't finalize the negotiations. You just can't do a deal, and that's tough. You can try your best, but if it isn't okay, you're back to down another snake again. If you have your offer accepted, at that point, that's the point to appoint a solicitor. You're getting into the nitty-gritty of the deal. So you've appointed the solicitor, working on the legals. You'll have probably, if you're working through a sales agent, you'll have signed something at that point, probably paid a deposit. And the next stage is due diligence and timing. Now, there's all sorts of due diligence that can take place once you're into that position, mainly due diligence, legal due diligence. But it could be that something comes up, something pops up unexpected as a consequence of that, which causes you to need to revise your offer. In which case, there's another snake. You've popped back from the due diligence box into negotiating and finalizing your revised offer and back round the loop again. Assuming that doesn't happen, we're coming along now towards the right-hand side. So the due diligence, the timing, everything's working out okay. At that point, CQC application would go in, and just before taking over, usually that's the timing of it, you would get to meet the practice staff, and finally the takeover would go ahead. I think, Nigel, you were saying that you wanted to have a quick word about that from your thoughts of going through this process twice.
Yeah, the first time that I went through this process, I was sort of relatively new in my dental career, and also obviously very, very new in this process, and hadn't owned a practice before. And we did it through a sales agent, and the process was really very smooth. Although in hindsight, had it have been the second practice that I'd have bought, there would have been a lot of changes I would have made with hindsight of owning a practice before, because the due diligence is really quite important, and I don't think that I possibly put enough emphasis on how important it could be in the information it could put up. The second practice that I bought was done without a sales agent, which did save some fees, which was great. There are definite benefits to doing it through a sales agent, though, because I think that there was issues that cropped up during the purchase of the practice that I think would have been smoothed over with a good sales agent that maybe weren't in our situation. It ended up taking really a very long time, and I think it could have been a lot more efficient had there been sales agents involved. And so I think there's benefits to both ways, really. The CQC application part of it, the first practice that I bought was before the CQC were around, and then the second practice, I just had to add a site to add a location, I should say, to my existing application. And so I don't know what the situation is with that, but I've heard that can be quite tricky.
Yeah, no, you're right, and the goalposts keep moving with it. I haven't a clue what they're like now, but the CQC were creating a difficult position of almost like catch-22 when, without going into the technicalities too much, when you buy an NHS contract, you have to go into partnership for the contract to be transferred to the buyer. And the CQC weren't acknowledging that partnership, so there was all sorts of problems with that. But this is an area where usually lawyers will hold your hand through that process. Okay, well, I hope you find that flow chart useful, and afterwards I think we'll work, for those that are interested in it, we'll send you a copy of it. That's absolutely fine, together with the slide notes. Moving on now to the next section about the value of a dental practice. And valuations of dental practice are based on a combination of fee income and profitability. This isn't rocket science, but it's a combination of the two. So looking at profitability here, this is a pre-seed version of a profit and loss account that's taken from a recent NASDAQ benchmarking survey, but it's simplified. So you can see that the gross fees here are 400,000, and we're calling this EBITDA, but effectively the net profit of the practice is £130,000. But EBITDA is an important thing to be aware of. It stands for its initials. It's earnings before interest, tax, depreciation, and amortization. It's a measure of profit, and the idea is that when you're talking about EBITDA, or when people in the industry talk about EBITDA, it's so that you can compare like with like, because often when you see a copy of a profit and loss account for a dental practice and it has as its bottom line a net profit, there are different accountants and different practices can have net profits that arise in different ways. In order to compare like with like, you really need an EBITDA. Now, the current net profit per principal for an average dental practice in the UK is about £130,000. It varies. NHS in the last survey was down to about 125,000 from memory, and private practice is a bit more at 140,000. Now, for this next little section, everything that we talk about is pre-COVID. You wouldn't have a profit and loss account that looks like this under a COVID scenario, but I'm going to give a bit of an explanation as to how that changes things in a moment. But the point I'm going to illustrate now is how confusing it can be for a buyer. That this is based on the NASDAQ averages of practice performance with an EBITDA net profit of 130,000. Now, I've just highlighted here, you'll be able to see the red numbers down the right-hand side. This is the same practice, but there's a very important adjustment. If you imagine that the practice on the left would be from a first-time buyer, so a lot of the work is being done by the principal. So you can see associate fees are at £90,000, so that is relevant to approximately £200,000 of the fees. So in this practice, about half of the work is being done by the principal and half's being done by the associate. The right-hand column would be what the numbers would look like if it was somebody's second practice. So in other words, or if all of the work is being done by associates, then the associates' fees go up, and that's what we have here. Now, we've called it here principal as associate. It's a bit of a clumsy form of wording, but I think you'll understand what I mean. The other way of looking at this is that imagine that this practice is being run by a corporate and all of the dentists are being paid as associates. That's what it looks like. And you can see from that the profit is much, much lower, as you might expect. Now, this, I think, is the real profit of that practice. You can only work out profits of a practice if you have a level playing field of all of the work being done by associates. So we've got two different profit and loss accounts for the same practice here. One is based on an average and one is based on all of the work being done by associates. You can also see from the NASDAQ survey that lab fees and materials, this is a percentage, it's about 6 to 7% for each of lab fees and materials. Employee costs about 20% and other costs about 13%. Now, when the viability forecast is carried out, that is a side product of the viability forecast is a comparison of the target practice with NASDAQ statistics numbers. Well, when UNW does a forecast, that's what we do. So to highlight during the course of the forecast, do you realize this practice that you're buying, the lab fees are a lot higher than the average? Why is that? And if the answer is, well, the current practice owner does some implants, that's a good reason why the figure should be higher. Dental materials, though, tends to be not influenced by specialist work. So if the practice that you're looking to buy has dental materials of 10% and the NASDAQ average is 6%, the question needs to be asked, why is that? And it's important. This is part of the simple due diligence. So that was talking there about profits. If we now look at once we've got profits, in terms of goodwill valuations, there are different ways of doing it. First of all, there's the old-fashioned way of a percentage of gross fee income. Now, I remember when I first came into acting for dentists, that you would have a typical practice. Let's say that its fee income was £300,000. The average goodwill value, now for you youngsters, you mightn't believe this, but it was a third. It was a £300,000 practice had average goodwill of £100,000. Oh, those were the days, weren't they? And then it started to rise. But more recently, or over the last few years, shall we say, as as goodwill values rose and rose, into the market came this other way of valuing practices based on EBITDA, a multiple of EBITDA. And that is a more sensible way. That's what sales agents will normally talk to you about. And then the final one, this was obviously pre-COVID, but in some parts of the country, not the Northeast, unfortunately, but inside the M25 and certain other areas, there was really no mathematical logic with regard to goodwill. The competition from buyers was so high that it was really just things off the scale. There was no maths. It was just sort of a market rate that drove the goodwill values. But for goodwill as a percentage of fee income, historically, I mentioned before, about a third of gross fee income. Immediately pre-COVID, from the NASDAQ Goodwill Survey, which I prepare for NASDAQ on a quarterly basis, private goodwill was just over 100% of fees, and NHS goodwill was around about 150%. And for larger practices, more profitable practices, it could be even more than that. In fact, in some instances, well over 200%. So that's one way of looking at it, goodwill as a percentage of fee income. But the other way, I mentioned EBITDA, and if we're going to be using a multiple of EBITDA, what figure should we use? Should we use the 130? Should we use the 220? Or should we use the 30? And this is where I start to run out of logical steam, really, because I think that there's a lot of fudging in the marketplace here. The correct way, if you've got a very large practice with a large EBITDA, then what will happen here is that there will be a multiple of this right-hand column. That's the most appropriate way to do it. If you've got a smaller practice, let's say anything that's sub £600,000-700,000, then if you work out what the corporate style EBITDA is, it won't fit in with the market rate. And what tends to happen then is there is something called an owner-manager's adjustment. Now, as a mathematician, I would say this is the fudge factor. It's what's done to get the numbers to multiply out correctly. And if there are sales agents watching this, this is where they'll be up in arms about how dare I criticize their methodology. But I'm a mathematician, not a sales agent. But it's very important that you get the correct EBITDA when you are working out a multiple of EBITDA. If we look here, this is quite an old example, but to illustrate the point, this was a practice that had an EBITDA of £700,000. It was sold a few years ago. It went to IDH. It went for £3.5 million. Gross fees of 1.8 million. And believe it or not, at the time that this practice was sold, I remember the principal saying to me, "The market has peaked. I'm going to sell it now, even though I don't intend to retire, because I think values will come down from now on." Would you believe that just before COVID, we were seeing practices not too dissimilar to this, going for a multiple? I think in one case, there was a case that was reported only a few months ago of 10 times EBITDA. So this practice could have gone for £7 million. Seems ridiculous, doesn't it? But at the time, it was reckoned to be pretty odd, 194% of fee income. So in other words, you multiply the 1.8 million fees by 194%, get 3.5 million. The practice owner was very happy at the time. But that's what we mean by a multiple of EBITDA. So if we're looking here at tactics, now, most of the people watching this will not be practice vendors. You will be buyers. So just think about this. you won't be able to set the tactics for when the practice is put on the market. So this is important for you, though, to be aware of what tactics the vendors are attempting. So if it's high profits, they'll be talking about an EBITDA methodology. If it's low profits, they'll be talking about a percentage of fee income. Now, as indicated before, there's a difference between NHS practices and private practices, and therefore mixed practices. There are different percentages that apply. And also there is this geographical factor, what I'm now calling a major conurbation frenzy. And it's interesting, when I first started to present about this, I called it London area lunacy, because it alliterated nicely. But I ran out of steam then when it started in Birmingham, Manchester, and other areas. So it's basically major conurbations, prices have gone crazy. Now, I asked in preparation for this for a comment from a valuer. And so Chris Bowles, who's head of dental valuations for Christie & Co., he's a chartered surveyor and is an acknowledged specialist, national specialist in valuations. The sort of people that you're likely to come across in terms of the sales agents, they are usually not chartered surveyors and therefore do not do what are called red book valuations for banks. But I thought it was important to talk to somebody who is carrying out that sort of work. Now read his words here. What Chris is saying is that sustainable demand, buyer demand, that's what drives valuations. And I was particularly interested in what was happening during COVID. And so what he is saying is that valuers will come up with a pre-COVID valuation and a current valuation taking current circumstances into account. And he's also saying that he would expect a more judicious approach from lenders in terms of risk and indeed the calculation of EBITDA. So there's a cautious note here. But the good news is that he thinks that once COVID, we're starting to come out of COVID now, once we're sort of out of COVID into what people are calling a new normal, he sees investors doubling down. Now, I went back to him and sort of asked, what do you mean by doubling down? He means that this is a sector which has great interest from investors and also from lenders. So that sort of counterbalances the cautious approach. Now, he hasn't been as specific here because I asked him to put something on the record, but I was talking to another chartered surveyor about this, another well-known firm that carries out valuations in the Northeast for lenders. And the good news from him was that as far as his firm is concerned, they are giving valuations to lenders at pre-COVID levels. But they're caveating that in a sensible way. Inherent within any valuation, there is a period of time for if things start to go wrong, how long will it take to sell the practice to get the sum that is set out in the valuation? And that pre-COVID was set at 6 months. So it's now by his company being set at a longer period of time, but their view is that the market will come back to where it was, and therefore that's what they're putting in their valuation. So in other words, valuations you have to be more concerned about what is going to come in them. There's more caution. There's likely to be less of a consistent approach, but it's not necessarily the situation where deals are knocked on the head because you can expect the valuation to be very low. And that is something that is going to keep the market going, and it's good news to that extent. Moving on to a different area now about operating dental practices. And the most common and historical way is to run them as unincorporated businesses, as sole trades, as partnerships, or under something called an expense sharing arrangement, which are really where you have a collection of principals that are working a practice together, usually 2 or 3, not usually more than that, but in theory it could be any number that you like, but 2 or 3, let's say that it's 3 principals working together in the same practice, but they are not in partnership, they're just sharing expenses. That gives them a much better control of their own profitability. And so those are the 3 most common ways historically, but limited companies have been allowed since 2006. And that in the dental world is a very good way of saving tax in a lot of circumstances. Outside of the dental world, the most common reason for having limited companies is to save risk. In other words, if you've got any friends who are running retail shops or restaurants, they're probably running those businesses as limited companies, but not to save tax. And it might be, but the most common reason is not to save tax. It's because with a limited company, if things go horribly wrong, to some extent, you can walk away from the business, allow it to collapse, and you do not have to pick up the tab. A lot of the business losses are left behind. But that's not the reason for most dentists doing it. The most common reason for dentists wanting to incorporate is to save tax. Now, on this slide is saying something else. The reason for that is that we haven't got time to go into it in this presentation, but there are lots of dentists who want to incorporate. They would dearly love to incorporate their practices, but they've got NHS contracts. And NHS England policy and rules are such that in most local area teams will impose significant restrictions and put obstacles in the way of an NHS incorporation, which gives rise to the wish to do something else. And I'm going to briefly talk about that. So I mentioned here about limited companies can help save tax. It also enables you to involve a spouse and split profits with a spouse, because under the Dentists Act, Dentists Act prohibits anybody other than GDC registrants from being a partner in a general dental business. So you can't split profits with your spouse by having him or her as a partner, but you can have him or her as a shareholder and split profits that way. The other big advantage of having a limited company is if your goodwill borrowings, if they can be serviced through a limited company, have the loan capital repayments, there can be huge tax savings. But in order to get the goodwill loan into a limited company, you have to have the goodwill in the company as well, which in the case of NHS practices means you've got to have the contract in the company's name. And there are problems there, as I mentioned before. The most common problem is the insistence of NHS England on a personal guarantee. Now, what does that mean? It's not just the fact that it's a personal guarantee, but it is given permanently. So in other words, if you incorporate an NHS contract, you were the contract holder just before incorporation, then what that means is that the company has the contract, which is great. You can have the tax advantages that we talked about. But when the practice is sold, what happens then is the company is sold. So you as the individual, you as the principal, sells the shares. You say goodbye to your company. Somebody else buys the shares and carries out the practice operations through the limited company. Great, you've sold it. You've got your money tax efficiently. But here's the rub, the unbelievable rub, that you will still be guaranteeing the performance of that contract after you've sold the practice. So you've got nothing to do with it, but you are guaranteeing the performance. If that practice has a clawback at some time in the future, and the company cannot pay the clawback back to NHS England, you, as the former practice owner, are still on the hook. Absolutely ridiculous. However, that is the situation, and that is the main reason why our clients have not been able to incorporate their NHS England contracts since NHS England came into existence in whenever it was 2014, with one or two exceptions, but there literally are one or two. And that's given rise to flawed incorporations and hybrid structures. I won't go into that now, but that is where structures have been set up that involve limited companies and involve NHS contracts in a way which, to be blunt, breaches the rules, but they've been carried out either because dentists have been very badly advised, or they're just prepared to take the risk, to be blunt. They're usually done through these things, which are called hybrid structures, where you have a limited company, but you do not have the contract in the company. More of that, it's a very deep topic, this, but not for today. This is just sort of touching on it. But I'm going to move on to now to the $64,000 question. Do the numbers add up? And this is through something called a viability forecast. Now, this is something that at UNW we are very, very keen on, almost insistent on. I am very, very reluctant to help somebody buy a practice without seeing a viability forecast. and hopefully you'll understand why when I run through that. So here is an example of a viability forecast, and I apologize because I know that a lot of dentists, most practice owners, most dentists, most potential buyers would rather not stare at a page full of numbers. So I'm sorry for that, but there's really no way around it. Now, but let's look at it in stages. So this is it's a very simplistic example. It's an NHS practice that has a £350,000 contract. This is the top line. And there's an asking price for goodwill and equipment of £500,000 and a freehold of £150,000. So it's a £650,000 deal. Now, if you look at the shaded rectangle about halfway down the right-hand side of the slide, you can see there how the purchase price is split. You've got goodwill and equipment of 500,000, freehold property of 150,000, and as a starting point, we're saying that you will have a deposit of £50,000, so you'll need to borrow £600,000. That's sort of the foundation of it. If we now move up to the top left of the slide, you can see where it says forecast profit and loss account, and you can see there that there's an NHS fees line, and this particular practice has got 14,500 UDAs. The UDA rate is £24, so we have the contract value, which is a few pounds less than £350,000. We move immediately to the right, and you can see there that the principal is going to do, so that this is the buyer is going to do 5,000 UDAs, and the associates are going to do 9,583 UDAs. So coming back to the left-hand side, follow down the model, we've got materials. This information is going to be coming from the accounts that the vendor makes available to the buyer. So we've got materials at £22,000. We've got laboratory fees, because it's a simplistic example, and I'm using the 6.3% percentage, the same figure, £22,000. And then associate fees, which are calculated at, for this purpose, we're using the full UDA rate of £20. In the industry, you talk about a £10 UDA rate because we're automatically taking into account the 50% factor. But for this model, what you would know as a £10 UDA rate, we're describing as a £20 one. But the associates fees are coming out at just under £90,000. So we then deduct the overheads of £115,000, and that gives this EBITDA figure, an adjusted profit of £101,000. What we then have is bank loan interest. We're calculating it at £600,000, and I'm using here an example rate of 4%. That's base rate plus the bank's lending margin, and that gives £24,000 worth of interest, which leaves us with a profit before tax of £77,000, against which is an income tax calculation of £22,000, leaving us with £54,000 before we start paying the loan capital repayments. And you can see there, goodwill, the loan is for £450,000. We've deducted the deposit from the goodwill loan, which is the normal way. And so, the loan term is 15 years. That's a fairly typical term for borrowing for goodwill, 15 years, which gives loan repayments of £30,000 a year. These figures are approximated. We're not using loan repayment tables here. The actual figures would be slightly different to this, but we're interested in the principle of it here rather than the fine detail of the calculation. And the freehold loan of £150,000 would be repaid over 20 years for this example, which is £7,500 worth of loan capital repayments. That leaves us with the princely sum of £17,393 per year available for the buyer to live off, because the way these forecasts are prepared, we don't put any quasi-associates earnings in here. The way that this works is whatever's left as the bottom line is available for the buyer to live off. So I would ask you the question, would you be happy to live off £17,000 a year? Answer, probably not. It's less than £1,500 a month. So at that point, this is pretty gloomy, isn't it? So we've had the excitement of finding the practice. We've gone through the initial process. We've got the accounts from the vendor. We've prepared our numbers, and we've come out with the answer of £1,500 £1,400 a month. So that's not very good. What can we do about it? Now, I explained before about this quite often happens, the first draft of the forecast, it's not looking very good. What can we do about it? Well, let's see. What about if the buyer can do a bit more work rather than 5,000 UDAs? Yeah, I'm prepared to do a bit more work in the practice. I did want to have a day off a week, but I can't do that now. I'm going to be doing, I'm prepared to do more UDAs. So here's the example here. You can look towards the top, the yellow shaded box in the top right-hand corner is showing 7,000 UDAs now. So clearly, the more work that the principal does, the less that an associate does. And you can see if on the left-hand side, about 5 lines down, associates' fees, that amount is reduced £71,000. And you can see the bottom line, we've now increased our monthly amount available from £1,400 to just over £2,300 a month. Now, that might be okay for some people, but let's presume for the sake of this example that we've set ourselves, unless we can make £3,000 a month from this. Now, for those of you who would have a personal threshold of 10,000 a month, don't laugh, but it doesn't matter. This is purely to prove a point. We're working towards a target, and if we can hit that target, we've got the green light to go ahead. If we can't, then it might be that we're going down a snake and we're going back to the beginning and looking at another practice. So we've got our monthly amount up to £2,355, the orange shaded amount at the bottom there. Okay, well, that's not good enough, is it? So what else can we do? Right, well, what about if we perhaps approach a different lender? Instead of having goodwill over 15 years and freehold of 20 years, then let's see what else we can do. Can we approach a lender that gives us more time to pay? So here we are. Goodwill is now repayable over 20 years. And we've got the monthly payment up to £2,980. We're within £20 of our threshold. Now, this is a very, very simplistic example, and there are sometimes situations with regard to that last point that there isn't another lender with a longer term. Come on to lenders more in a moment, but sometimes there are. But I'm just illustrating here, there are things that can be changed within the first viability forecast, and it's very important that you are aware of what your bottom line is going to be, that you're not just blindly going into this based, as I've seen some people do in the past. I've sadly taken over looking after clients where they haven't done one of these forecasts, that lenders have been so keen to make the loan and to fund the practice acquisition that insufficient detail has been gone into in no forecast like this has been done, and there hasn't been sufficient personal funding available at the end of the day. However, so we've got the 2,980, we've got it, but we want to get this over the line. So what about the deposit? £50,000. Well, bank of mum and dad. Let's go to mum and dad and see if we can get some more money. We'll get that up to £75,000. And bingo, there we are. We've achieved our target. The bottom line is now over £3,000. You can see on the right-hand column, the yellow shading, the deposit's now £75,000. Now, a proper viability forecast is more detailed than this, but still has within it the features. We set it up with yellow shaded cells. These are the ones to go and play with. You know, what we haven't done here is we haven't gone to the associates fees, and actually the figure is probably too high to do this, but imagine the first draft of the viability forecast was using an associates rate of let's say £25. And is there a possibility, so a £12.50 UDA rate to the associate, is it possible to negotiate lower associates fees? There are all sorts of possibilities that we can bring into play. Now, what we were talking about before was obviously pre-COVID. I thought you would be interested in this. Again, it's another page of numbers for which I apologize, but this is a very simple ready reckoner that we produced for our practice owning clients to illustrate the impact of COVID. And what we have here is, if we go up to the top section where we've got numbers of patient a week, so we've got pre-COVID 400 patients a week, post-COVID on an estimated basis, because of fallow time, we think we can only look after 80 patients a week. Okay, so that's not good news, but we're going to look at below the impact on on the practice profitability. We've then got the green box, the next line that we come to, extra PPE costs per patient, £40. Now, I know Nigel will probably tell me in a moment that this was actually drafted a few weeks ago. PPE costs, I suppose, if you can get hold of them, have probably come down a bit. But again, we're illustrating the principle of it here. So we've got far less patients, and we've got extra costs for PPE. If we look down the left-hand side here under the heading of financial information, these accounts here are for pre-COVID. So it's the last set of accounts pre-COVID. The figures that are on my screen are coming out at a sort of a skin-coloured, whatever that is, sort of but you get what I mean. Private fee per item 300,000, capitation 100,000. Follow all of that down. You can see that there's lab fees, materials, etc., etc. So the pre-COVID gross profit was £172,000 a year. Don't worry about the word contribution. That's something that accountants use, but it's gross profit of £172,000 a year. What hasn't been deducted from this is the telephone bills, etc., etc., the expenses that are required in a practice. But that isn't really important for this comparative purpose. So we've got a gross profit of 172,000. The next column is those numbers expressed on a weekly basis. So we've divided everything by 52. You can see the gross profit has come down to £3,308. Now the COVID impact, the next column along, shows what happens with the reduction in the throughput of patients and the increase in PPE. So coming back up the page, the actual fees that you've got coming in have been reduced significantly because of the drop in patient numbers. So you can see here the total fee income of 1,577, and the extra PPE costs are coming in at £3,200 a week, unbelievably. But you can see here that the pink figure, instead of having a gross profit of 3,308, there is actually a gross loss of 5,185. So in other words, the situation's gone down by £8,492 per week. And in order to restore that, to get profits back up to the level that they were before COVID, would require an increase in fees per private patient of £106. Now that's just to give you a flavour of things, and that's done quite deliberately, in the sense that if you are buying a practice now and you are presented with accounts for pre-COVID, then whilst the adjustments certainly will not be as per my very simplistic example, it gives you a flavour for what is going on behind the scenes, and therefore needs to be taken into account very, very carefully when you are planning an acquisition. Until we get back to new normality, we have to look at the numbers in a lot more detail and in a different way. So that's just a flavour of that. I said I'd talk about lenders. So with lenders, for first-time buyers, you can see the column there, Lloyds Bank, Barclays, Wesleyan, and NatWest are interested in first-time buyers with relatively low deposits. They all have their different formulae, if you like. On the right-hand side, I won't go into details there, that's not for this session, but there are other lenders that are not really interested in first-time buyers. What do dental lenders want? There are three key requirements to be aware of. Number one is the deposit, and talking to dental accountants, talking to sales agents, you'll get an idea and understanding of the pattern for each lenders. Some require more deposit than others. Some will actually be happy with provision of security as opposed to cash. And again, this is where Bank of Mum and Dad can come in. If Bank of Mum and Dad has got a property with no freehold property with no loans on it, then they might be happy to allow you to use that for security purposes, which can give the green light to go ahead. Banks will need financials, usually 3 years historical accounts. They will need either a viability forecast of the sort that I've outlined here, or some rough equivalent of that. Some lenders need less information, and therefore there's a temptation to say, I won't bother with a viability forecast. But as I say to all of my clients, I'm not doing this viability forecast for the bank, I'm doing it for you. I want you to know that this is going to work for you. And as it happens, banks, lenders love these viability forecasts. It does a lot of their work for them. And then, of course, the other thing, I'm saying, of course, you might be aware of this, but from talking to lenders recently, we spoke to Wesleyan, Lloyds, and to Barclays. They will all need some indication of reopening profitability. But interestingly, that they're not going to base their decisions on that. It's just simply the fact that information is there that gives a flavor. The decisions for most lenders will be based on pre-COVID profitability, with the as long as it is reasonable to presume that things will recover to the way that they were before. And then finally, I mentioned valuations. This is the stage that a valuation is required, and not until a specific lender. You're at this stage with a lender. And the reason for that is if you go out and commission your own valuation, and that costs you whatever it might cost you, a few £100, then you cannot use that in support of your lender's valuation. They have to have a specific one of their own. And in terms of offer formalities and legal aspects, when you make the offer, be very careful about the conditions, because your offer, if it's in COVID-affected territory, as it will be for the next few months, then it's likely that it would make sense for your offer to be made subject to fee income recovery. In other words, if pre-COVID the practice turnover was 500,000, you need some sort of reliance on profitability returning to 500,000 during your ownership. But more important, I would say, you need to know that profits are going to come back, because whilst fee income might come back, what about all the extra PPE costs? And the problem with profit recovery is, as indicated before with EBITDA situations, it's very difficult to have a tight definition of profit. And you need to be aware that you need to pay a sales agent's deposit when you make your offer, usually, and therefore make sure that you fully consider all of the conditions, because that deposit is set out in a way which, although in theory it can be returned, under most circumstances it is effectively non-returnable, unless you find something that should have been disclosed beforehand that wasn't. Legal points, there are the whole business of legal issues. Lawyers do presentations that cover this in depth, but very briefly, if you're buying an existing limited company, then it's much more complicated. Sorry, I missed the first point. There will be a sale purchase agreement. That's what the legal agreement is called. The letters SPA are bandied about, and usually you're buying assets, goodwill, and equipment, perhaps a freehold or a leasehold. But if you're buying a limited company, the situation is much more complicated, and the legal agreement is more complicated, just because of the fact that it's a limited company and you're buying shares. And then what I think will become very common, but was quite uncommon before on private deals, is retention. That it is almost certain that if deals are done during the COVID period, that the buyer will not pay all of the monies over. This is bad news for those practice owners who are watching here, that rather than getting your £500,000 or whatever the figure is for your goodwill and equipment on the day that you sell, that only some of it will be paid over. Let's say £400,000 will be paid over, £100,000 will be retained for a period of time until the various conditions that are set out are satisfied. And that, I think, will become almost standard practice. But as I keep on saying here, it's not just the fee income that needs to recover. Profit is the most important factor for buyers. So a very simple action plan before we have the questions and answers. Find a practice that you like. Appoint good advisors. UNW will look after you if you like. We would always love to have some new clients. And very, very importantly, do the numbers add up for you? And the viability forecast is key to that. Obtaining funding, again, we can help you with that. And completing the legal process and living happily ever after, of course. So that's our run through. And now there's some time for some questions and answers. and Nigel will help me with that. I'll just stop sharing my screen so that we can come back on there. Okay, so now we've got 4 questions in the Q&A box, so I've opened them up here. So Liam and Mike, I don't think there's any need for you to help me with that. But so the first question from Bernardo Carria is, what are the perspectives in loss of income with this lockdown, and for the future, can we expect the same profit? Well, I've been blathering on, Nigel. Is that a one that you would like to, from your perspective, do you think that, are you expecting your profits to come back up to the previous levels?
Yeah, I hope so. I hope to have a bit of a bounce as well with with some of the treatments that I do, specifically regarding implants. And it's awful to say it, but I'm sure there's been some teeth that have been removed that possibly wouldn't have been otherwise, which desperately trying not to sound like profiteering on the situation, but there will be some excess work to do there. There's definitely been quite a significant hit with the with what's happened at the moment, even though both of the practices are more NHS than private, and the NHS have looked after us reasonably well. I can see it coming back to what it was pre, and hopefully even better.
Yeah, and I think that's the general presumption. The problem, particularly from sort of people that are trying to do financial forecasts, is estimating what that period of recovery will be. And it depends on your degree of optimism and pessimism. That if we don't find a vaccine and things have to keep on as they are now, then it's going to be a long time before profitability returns. But if there's a vaccine and that can be what's the word, sort of people can have the benefit of it quickly, then I would like to think that within 12 months we're all back to, people talk about new normal, but we're back to a normal level of profitability. So I hope that's okay, Bernardo. For the next one, Jayesh Patel is saying, buying from a corporate has the upside in profit of firing an associate and taking over. Oh, I don't know if I like the sound of that, Jayesh, but yeah, now I think with this buying from corporates is before COVID it was a market of its own, because typically buying from corporates was done at depressed pricing, or at pricing underneath the previous market rate. So I think it did have a potential in terms of buying at a lower rate, but from my experience, people that bought from corporates were buying unhappy practices, and therefore you're paying less, but you were getting something that it was perhaps more difficult to make a profit. In terms of firing associates and taking over, putting that in a sort of a more human way, within the viability forecast, I think there are often situations where the team changes. You can have husband and wife that are dentists, and therefore, sadly, associates, you won't need as many associates. But this is another advantage of the viability forecast. The viability forecast shows what the profit, not just the profit and cash availability will be for you. And each buyer is distinct and different. And therefore, I've seen some situations where one buyer of a practice, it works, and another one, it doesn't, for the same asking price. So it's just another example of why viability is important. So next one is from our good friend Steve Pratt from Lloyd's, who he is one of the preeminent dental lenders nationally, based in the south. And his question is, Alan, just had a valuation from Christian Kobach, pre-COVID goodwill value 720,000, post-COVID 600,000, fully private in South London. We're seeing more cases where an escrow account is being set up with funds released against meeting income targets. That's 2 separate points there. And so thanks very much for that, Steve. And it's helpful to have a banker's input. With regard to valuations, first of all, this is a bit. it's been very difficult, I think, to get to the bottom of this, because I think I've indicated that Chris Voles from Christie's wasn't definitive in what he was saying, and there's some variability there. And if he's saying pre-COVID 720, post-COVID 600,000, that's very interesting. And if that is typical, what does that work out in percentage terms? Is it about 15%? That's actually in line with some discussions we were having at a virtual NASDAQ meeting early this week. And with regard to this retention escrow account, I think that's going to become standard practice. And it's very interesting, again, meeting income targets. I'm really worried about this, to be honest. And as our focus tonight is with buyers, I think I'll repeat it again. I don't think it's good enough to have income targets being hit, because what happens, God forbid, if we need extra PPE forever? Then it's all very well having your income up to the previous level, but if your costs are higher, then you're not going to make as much profit, which one way or another should impact on values. Next one from an anonymous attendee: what sort of deposits are typical for a first-time buyer? And this does vary from lender to lender. It also varies with regard to the type of practice. But I think the minimum, it may even be, I think I was told pre-COVID that NatWest were still doing deals with no deposit on NHS practices. Now, this is where Steve is probably jumping up and down wanting to say something, and he probably wants to say yes, but their lending margins would be astronomical, and currently you're probably not going to be able to borrow anything from them anyway, because forgive me, NatWest, that I have heard that NatWest lending to dentists has been, well, I was told it was temporarily stopped as a consequence of COVID. But so thanks, Steve's come up with a very helpful. I'll come back to myself. Steve is saying typically Lloyds will ask for 10%, but each case on its merits. So that's very helpful. Thanks for that, Steve. And I know the people at NatWest very, very well. So I'm just trying to pass on information here. NatWest are very strong in this marketplace. I have heard that they are on a lull with lending to dentists. If I'm wrong with that, then I'll be happy to put that right. But there's only one way to find out. But to be positive about NatWest, they were lending in some situations with no deposit. But 10%, I think, is probably the norm. But there can be some, I mentioned the ones on the right-hand side of the slide: Santander, Yorkshire, Clydesdale, they're typically 25%. Wesleyan are sort of around the 5-10%, but they will also have a situation where they will take deposits, which may also be the case with Lloyds, actually, Steve, if you want to sort of put a thing on about a chat on that. So next question: as an accountant measuring business, is it still good business to go into or wait a few years? Well, that's a really tricky one. I need a crystal ball. I think that it will, in my view, it will be a good. It will come back to be a very good business to own a dental practice. I've no doubt about that. It's just a question of timing. And I don't think that it's a question of years. And I think the good thing here, from the buyer's point of view, that there are some issues with when we've had a number of clients who were due to complete on deals, during COVID, and with one or two very small exceptions, I don't think it makes sense to complete a deal at the moment. There are too many uncertainties. But for those of you who are contemplating having an acquisition, even if there was a fantastic fair wind behind you, you're not going to do it, or you'll be pushing to do it within 6 months. Typically, I think the average deal was taking something like 9 months. So I think that actually, I've noticed that my colleague Mike wants to help out with this, answering this question. So Mike, over to you.
No, no, no. I just think it's going to be my mistake. So carry on.
Okay, all right. I beg your pardon. I thought you were interrupting to sort of with a helpful point there, Mike. No, don't worry about that. So no, I think it depends on where we're looking at here. To sort of summarize my answer here, I think it's a good business. I think somebody that's interested in buying, you can start the process now, and before you have to actually commit in 6 to 9 months' time, it will be a different world. So you know, if you're itching to get into practice ownership, there's not a problem with starting the ball rolling now. However, if you are due to complete quickly, I think that's a different scenario. You need to be very, very careful about that. I'm not saying don't do it, but I think I'm saying probably don't do it just for the moment. And most vendors are understanding of that. They'll allow you a bit of a time. So next one, as a prospective first-time buyer, is it likely that there will be competition with other buyers and sellers look more favorably on buyers who are more established with perhaps a practice already? I don't think so. No, I don't think so at all. In fact, I was talking to Nigel beforehand about the difference between buying a first practice and a second one. Do you want to chip in on that Nigel?
Yeah, I think it'd be very, very personal to the vendor and sort of how well you as a prospective buyer got on with them. From my point of view, if I was looking to sell my practice, I don't think it would matter much either way. I think potentially if I was being asked to work within the practice, I maybe would prefer it if the incoming owner had worked in a practice before. Sorry, had owned a practice before, but I think I would put more onto how well I got on with them and how the sale process had been.
Okay, I'm just looking down. We've got quite a few questions. Yeah, I'm happy to keep going. For those of you who need to go, because we said an hour, then you know, obviously feel free to disappear. But we'll keep going and just and answer some of these questions. If we run out of time, we will do it by email if that's okay. Just looking down here to see if there's anything specifically for Nigel, but I don't think there is specifically for Nigel. It's asking, a quick one here. Can other family members not dentally qualified be shareholders in a limited company? The answer to that is definitely yes. Anybody can own shares. That's one of the advantages of a limited company. Whereas if you don't have a limited company, the other members of your family cannot join in as owners unless they're GDC registrant. So that was a quick answer to that one. Goodwill values as a percentage of fee income, and asking about what's the going multiple of EBITDA in the Northeast presently for valuation. Well, presently I don't think there is one. I don't think there is all bets are off at the moment. But going back to pre-COVID, the thing with EBITDA is I think it's really only relevant for those jewels in the crown. You know, like that one that I illustrated, a £700,000 EBITDA. Pre-COVID, I would have expected that to go for a multiple of 6, 7, possibly 8. I mentioned a one that went for 10 in Yorkshire recently. But the sort of practices that I think are going to be hit hard after COVID are those sort of practices. And I didn't mention that because they're not going to be bought by people watching this. Historically, they were bought by the corporates, particularly the likes of Bupa. And Bupa seem to be on a buying frenzy, paying very, very high multiples. Great if you are a vendor. We had a couple of our clients that we helped sell to Bupa, and that's wonderful. But for a typical first-time buyer, a multiple of EBITDA, I don't think is really relevant at all. And in fact, I would just come back to work through a viability forecast. That tells you whether it's worthwhile for you or not. If this question is coming from a vendor, then and if you've got a practice that isn't of interest to a big player, then you're into this owner-managed multiple from a multiple which is typically being fudged. But to put what do I mean by that? So I don't think it is. I don't think it is an EBITDA if it is a practice for a first-time buyer. And yes, 150% is where things were typically in the Northeast before that. Then it's being asked, can please repeat what would happen if there was less than expected income band? That typically would not be the case. This is asking you about retention. If I'll just read this carefully. What would happen if there was less than expected income bounce back? Would the purchaser have any recourse? No, right. What I think this question is about is that, let's say that the turnover pre-COVID had been £500,000, and that the goodwill, I'm going to use pound for pound here just because it makes the maths easier. So a private practice being sold for £500,000 with a turnover, being sold for £500,000 goodwill. Then let's say that there's £100,000 retention, and so if after the end of the year the turnover is built up to £450,000, and that would have to be done on a month-to-month basis, looking at how things were building up, not on a cumulative basis because that wouldn't work. But in month 12, the income, when you multiply that by 12, comes to £450,000. Then you're £50,000 short on that definition. So in other words, what would happen then is you'd have £100,000 in retention, the vendor would get £50,000, and the purchaser would get £50,000 back. That's a very simplistic example. You wouldn't just obviously base it on 1 month, but that sort of illustrates the principle of it. There'd be money held. There'd be a formula for working out what the goodwill, the calculation of the goodwill based on turnover after a period of time, and the money would either be released to the vendor or paid back to the purchaser. So the next one, should we be looking at NHS heavy practice for long-term stability and profit? Well, I think with the beauty of NHS is that currently, or to use the words from the CDO's letter, initially, the less abatement, NHS contracts are being paid in full, and therefore there's stability and profit there as a consequence of that. But we haven't a clue what's going to happen down the line with the NHS contract. The market is perceiving the NHS contracts and goodwill as having stability, which I would go along with that, is what I think will probably happen. But we don't know. It could be a situation that there's a CDO's letter tomorrow that says initially has finished, you're now back into UDAs. Take that, boys. Well, I mean, that would be, you wouldn't like that, would you, Nigel? So I can't see that happening, but it could. So we don't know. So how is the valuation of NHS practice, portion of mixed practice and possible new NHS contract coming out? So I think I've probably covered the NHS contract part of that. We don't know what is happening with valuations. Or certainly I've heard situations with retention. Again, this was talked about at the NASDAL meeting yesterday, that in a deal that happened recently, the NHS goodwill went ahead at its pre-COVID value with no retention. The private portion of the goodwill, because it was a mixed practice, had some retention. Next one from Alex Sharp. How do you do a viability forecast if you're planning on starting a practice from scratch? Good question, Alex. And that's something that again, Nigel and I did on a number of occasions, trying to, before he found the second practice. It was difficult, wasn't it, Nigel, doing a viability forecast for a squat?
Yeah, literally impossible, because there's maybe, Dad, you won't like what I'm going to say here, but there is guesswork in a viability forecast, and that guesswork is multiplied by 1 million once you're doing a squat, because it's based on numbers that you think you can generate, costs that you don't really know. The viability forecasts that are done with the practices that you're going to purchase are all taken from accounts that are given to you by the vendor. So at least you've got something solid to go on. But we looked at a few different models of doing squat practices, but we couldn't get it to work on a viability forecast point of view.
Yeah, and I think the viability forecast that I've done for squats, the valuable part of it has been with the overheads. In other words, working backwards, I think is a good idea with a squat. So you can project what your rent is or what your property costs are. You've got some idea about what your phone bills are going to be. You can work how much staff that you're going to have to start off with, and that gives you a certain level of base costs. You can then say, and then of course you will, unless you've got other income, you'll have to say, well, my £4,000 a month that I need to live off, I need to add that on. So you've then got an amount that you can work back up over and say, what level of fee income do I need to generate in order that after the material costs come off, I have that amount of money left. So they're still useful to do. I've written an article which I think is quite good about setting up a squat. If you'd like that, Alex, then pop me an email, and it goes into more detail with things like lenders, for example. Lenders have a totally different attitude towards funding squats. Okay, so then anonymous one. I sold my practice. I was a sole trader, and the contract is currently in a partnership, but hopefully we can inform CQC that I wish to retire. Is it okay for me now to claim my pension as the contract is now in a partnership? And secondly, they are proposing I come back as an associate. Would you advise I incorporate now as a part-time associate working 1.5 days a week, or is it best to remain as a sole trader? Okay, a full load of questions there. Firstly, and this is where we need a lawyer. I should have asked a lawyer to join in on this. But as far as I'm aware, if you, whether you can retire or not, it depends on if your name is on an NHS contract. So if you're in the partnership, I think normally what would happen is, as part of the sale process, you pretty soon after sale would be resigning from that partnership, and that's the best time to retire from the NHS. We need a lawyer's input as to whether it will work or not. I suspect that you can't retire from the contract when you are in this partnership as part of the sale process. So come back as an associate. It almost certainly isn't a good idea to incorporate when you are an associate. The one reason is, which probably won't apply to you if you're retiring, but you can't be incorporated. Oh, hang on a second. I've got Alison Oliver from Hempson's who's answering my question. You need to be removed from the contract to claim your pension. So yeah, so you need to delay, anonymous. You need to delay your NHS pension situation until you are off the contract. So hang on a second. Where are we? Proposing to come back as an associate. Yeah, I wouldn't incorporate unless you've got so much income that you don't need to spend the income from your associate work, or in some situations you are splitting it with a spouse. But the big problem with small incorporations, as I would call them, is that since last tax year there's been an extra amount of income tax of 7.5% due to the abolition of something called dividend tax credit. You need to do the maths, but probably it's not a good idea, but worthwhile doing the maths before you take a decision. Next question from Mahesh Patel. When you say incorporating after 2014 would have consequences post-sale for the vendor if there's an underperformance, what about those incorporation that was during the PCT era? Right, well, all of this depends on the actual contract. The corporate contract. If you incorporated prior to NHS England, then as far as I'm aware, those contracts never asked for a personal, not asking is the wrong word, those corporate contracts did not contain a personal guarantee. It was an invention of NHS England to insist on a personal guarantee. But this is all about the contract, where whether you've got a personal guarantee or not depends on the contract or the novation agreement. There are different ways of doing it. So next one from Robert Hetherington, maybe one for Nigel. When you purchase a practice, you're obviously at the height of your debt mountain. Whilst you can take the bottom line of profit, how much of that profit do you feel you should be putting to one side in those first years and leaving in this business for those bumps along the way? Well, go on, Nigel. It's one for both of us to answer, I think.
in my case, there's been a lot of times where it's been the money put to one side is literally been all the money that I've needed to pay for tax, because we've made investments. I have sort of been quite bullish with buying stuff for the practice, and there's not been a case of, well, I'll keep this bit aside for buying my Ferrari. But I think that the take home from me would be try and put as much as you can to one side, because there can be fluctuations in tax when if you make big capital purchases with building extra surgeries or things like that, then tax may be lower the year after, but then you get a second year bump, and that's where having really good tax planning can come in. And there's obviously the business bumps where things break and you need new things, and so in my case I put as much as I can, but it's not a case of it always being enough.
Yeah, I think the problem is that goodwill values have risen so much. Remember in the presentation I said when I first came into this that goodwill values were a third of turnover. They've gone up to such an extent that it is now extremely difficult to be able to fund the practice with a deposit, with bank loan repayments, as Nigel said, paying tax. That the majority of acquisitions go through, and they are what I would call, they're very, very tight. So if you are lucky enough to have a safety margin to be able to save, then yes, that is very, very useful. But most acquisitions, there is no safety margin in the first year or two. And in fact, I've been helping out with a task group. The new deputy CDO, Jason Wong, has been charged by the CDO with evaluating potential dental practice casualties. And I was asked if I would join in that task group. They had a meeting this afternoon. And along with the great and the good, we'll go through the sort of the cast list, but BDA, all of the dental bodies, the CDOs, offices, etc., NHS England. The biggest at-risk group are those practice owners who've recently bought practices, because they're highly geared. And the worry is that those practices that were highly geared before COVID, because they couldn't put funds to one side, as your question asks, have now taken on, in some instances, bounce back loans, SIBLs. The servicing of that debt is something that never appeared in the initial viability forecast. And it makes sense to take on that debt if your alternative is not being able to pay your way. But my big concern is 12 to 18 months down the line when these supported loans need to start being repaid. But that's slightly off-piste at the moment. That hopefully answers your question. Some more ones that I think that we've sort of covered about retention. I think we've covered that. There's a one here, I'm not sure whether it's a statement or a question. The valuations reflect the build-up to get back to profits. The valuation is as today and reflects the current trading levels. The multiplier to EBITDA reflects the time it takes. So 1 times EBITDA is essentially a 1-year build-up. Okay, not sure what to make of that. Alison Oliver, lawyer, Hempson's, is saying we now have deals at Henson's which were paused pre-COVID and are now aiming to complete in September, which is encouraging. Yeah, it is. I think the communally, the more experience we have of things starting to work again, the better it is. What is my view on deferred percentages? If by that you mean, does that mean retentions? Well, I think from the vendor's point of view, as little as possible, and from the buyer's point of view, as much as possible. But we need to get, it's another example of a new normal. We need to know what is typically happening. There's a lot of debate amongst that currently amongst dental professionals. Right, here's one for Nigel. Future thoughts on buying NHS versus mixed, high, low percentages of each versus a private practice.
I think it's a very personal perspective on it, because if you'd have asked me sort of 7-8 years ago, then I was very much of the mindset of buying NHS only. I wasn't doing very many sort of high value private treatments, and I felt I could work quite quickly and efficiently, and so I really only wanted to buy into the NHS side of things. As I've invested in myself quite heavily with postgrad courses and various bits of kit, now I think if I was to buy a practice, I would only want to go within the private sector, but there's very much a geographical sort of side as well in the northeast of England, which is where I am. There's not a huge amount of high value NHS, so high value private practices around, and lots of them have actually been bought out by corporates now. And so I think unless you were to go down the squat route, which has its own risks, as we discussed with an earlier question, then it's difficult. I think the way that I'm moving my practices is to be geared so that if something does happen within the NHS, that we are in a position that we can turn that off and go private. At the practice that I bought 10 years ago, I'm already fully private there, and we're in a position where we're trying to move the associates over so they have the capacity to be there. The practice that I bought sort of 2.5 years ago is obviously quite far behind in the development. It was a very NHS practice, and we're just trying to change the sort of the atmosphere and the change everything about it to be a lot more privately minded. But it takes time for the culture of a practice to shift. But I don't think, first of all, I'm going to buy any more practice at this time anyway, but I think if you have an NHS practice, in my opinion, I think you need to be mindful that the goalposts could move, and having just one single customer, as in the NHS, maybe isn't long term the best idea.
Okay, thanks, Nigel. So there's one here from Mahesh Patel asking, what is our fee to carry out a feasibility study, survey, viability forecast? Presumably means on a practice for sale near me that looks like a good investment on the face of it, a distressed sale, freehold, nicely appointed planned patients. Simple answer to that is that we have a discounted fee arrangement when we're helping people buy practices. It's our investment in growing our business. So to answer your question with a number, it's usually around about, it could be as little as £300 or so. We operate at a 50% fee discount when we're doing viability forecasts. In fact, when we're helping clients buy practices, if we are to be appointed as the practice accountant. So we actually lose money on every person that we help buy a practice, but we're investing in longer term clients. The reason why we do it that way is that we're often asked, most things that we do are on a fixed fee basis, which I know is very important to work on a fixed fee basis, no surprises, but we found pretty early on we can't help people buy practices on a fixed fee basis. I'll give you a shining example of that. The deal that stopped me doing it was where it was an acquisition of a limited company where fees are a bit higher. I quoted £2,500 fixed fee. Our time costs for doing the deal were in excess of £15,000 because it was so complicated. So from that point, I said, we can't do that anymore. But typically, the cost for helping somebody buy a non-limited company from start to finish, including the viability forecast, would be something like between £1,000 and £1,500. But the viability forecast element of that, it takes about 2 hours. And so you're looking at something that when the 50% rate is applied and the VAT goes on it, about £300 is the answer. And what you're getting for that is not just the maths, but an experienced individual. It's not something that we give to one of our kids that's good at Excel. It's done by me, Mike, Liam, somebody who is deeply ingrained in looking after practice owners and practices. So what we're doing is, as we're going through it, we're saying, oh, that looks a bit odd, that percentage is a bit high, what's going on here, so that you're getting due diligence done as part of the process. I hope that answers that. Okay, well, I think we haven't covered all of the questions, but it's now, we've been going for 50% more than the allotted time slot. But the ones that we haven't answered, I think, have been touched on in answers to other questions. So hopefully everybody is happy through this. So I'd just like to thank you all for attending, for watching. Thank you very much indeed. We've had a really good response. It was up to about 80 most of the way through. I'd like to thank Nigel, my favorite client, and for helping out. And obviously Liam and Mike, thank you very much for helping, and our marketing team, Richard and Daniel. So if there are any follow-up questions that we can help you with, you know where we are. Pop us a line. If you wanted to have a sort of a confidential private chat, that's fine as well. We'd be delighted to work with you. And with that, thank you very much and good night.